Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we know, and as you're probably looking at your portfolio and your statements, you have seen a lot of damage that's been done, certainly over the past couple of months. It's always really important to take a look at the technicals within the market. So I wanted to bring you a market technician today to really see where the markets are at. Have they bottomed? Have we seen capitulation? And are there some opportunities? And what kind of damage has been done? And how severe has it been? For that, let me bring you Sid Mokhtari today. He's our guest. He is the Chief Market Technician at CIBC Capital Markets. Sid, great to be able to be with you and get your perspective for our viewers today. Thanks so much. Thanks. Sid, I want to first get your take, kind of just big picture from the CIBC view. The thoughts this week as it relates to the BOC, raising rates by 50 basis points, perhaps less than expected. We also had a U.S. GDP print this morning that was a little bit better than expected. We pre-taped this on a Thursday. What do you think of what we're seeing right now, big picture?
Well, the big picture is still the balancing act between inflation and employment, right? So I think globally there is a coordinated effort to address this inflation that seems to be somewhat sticky, and everyone has a target for their inflation number. So however we look at it, we do assume that at least in the U.S. We need to see employment to respond to what the Fed's doing, and that hasn't yet happened. So um, we're still viewing that both US and Canada are probably going to stay the course in terms of rate cycle, and not much is changing from that perspective when we read our chief economists at CIBC what they say, and even though Bank of Canada let's say put the brakes on the on the rate hike that they had 50 instead of 75 beeps that was fully priced into the market, but it doesn't really mean that they're going to change the course, so we still believe that rate hike cycle is still in full force. We can't really change that narrative yet, to be honest with you.
Hmm. Okay. And the change in rates, going from a decade or more than that of rate declines to this change with rate increases has done so much damage to the market. Rates rise, valuations decline. What kind of damage have we actually seen? Everybody has their own specific stocks that they're watching, but when you take a look at the S&P or the TSX, what does it look like versus history?
So rate hike cycles historically are not necessarily a positive for the risk assets, right? So, and that is what we're going through. Um, we do believe that bulk of the damage is already probably done. Most of the damage. It's very reasonable to say that peak to trough. Most indices constituents, particularly small and mid caps in the US, have corrected in excess of 50%. So when people say what the benchmark index is only down 20%, internally it's a lot deeper, it's a lot worse. So a lot of damage has been done, exactly to your point. Have we seen the bottom? Maybe in a lot of areas, like I said, bulk of the damage is done, but when people gauge a bottom or a peak for the market, they often refer to the S&P 500 as the as the benchmark to gauge whether a bottom has been achieved or not. For that, we assume that the bottom is probably not in yet. We do think we have a very strong seasonal backdrop for the market as we go into year end.
Hmm.
And I also want to highlight one more thing, that year three in presidential cycle, which is next year, is usually the strongest year. So I do have a lot more optimistic views for next year relative to this year, particularly comparatively when we look at the returns that we've had this year so far.
Interesting. Also interesting, though, to point out that the past quarter, I believe, or maybe September, was the worst September we've seen on the TSX since 1970. Is that
You
true?
got it. I mean, that's very true. And I mean, it was. I mean, it lived up to its standards. What September is all about, the weakest month of the year, right? And October is usually the most volatile month of the year, and we have had some of that volatility as well. But to a point that you made earlier about capitulation, we really don't know whether or not we've seen it. We still believe that we get. Um, you know, uh, Periods that there are counter trend rallies, market gets exhausted on the downside, and we get you know bounces because of either earnings or sentiment shifts. But I'm not
Right.
quite sure whether or not we've seen the lows yet on that front in terms of capitulation.
Okay, we'll take a quick break. We'll be right back. So, Sid, I just want to pick up on something you said. You're not sure if we've seen capitulation. I mean, when we do talk about some single stock stories being down 40, 50%, a lot of people are going to hear you say that and be like, wait a second, like, I don't want to see any more damage to my portfolio. Are there certain areas that you're more concerned about when we talk about capitulation?
Yes, and that's a great question, and thanks for asking that. I do believe that this rate hike cycle, at least the rising rate environment, is not very friendly toward the likes of technologies of the world, right? So that's the area that we are still showing very problematic relative strength compared to the market. So good parts of the market are already down to a great extent. So we do assume bulk of the damage is done. But at this point in the cycle, which seems to be late innings, either on rate hikes or rising, 10-year or 30-year long bond yields, or where equities are in terms of benchmark indices, I do think we are in late innings. But to suggest that a capitulatory environment has happened is difficult. We haven't seen the kind of surge in volume in sell-off periods. We haven't really seen a sharp spike in volatility indices yet, right? So we are monitoring for all that, but it's very difficult to call for capitulation at this point in the cycle.
Okay. When we talk about tech stocks and the damage that's been done there, just the loss of market cap, it's interesting. I think that the value of Facebook is similar to what it was 10, 15 years ago. I mean, that stock's been really punished. Part of the issue for many US companies has been the strength of the US dollar, their global companies. What do you see as it relates to the U.S. dollar? The strength has really damaged so many companies and country currencies as well, of course. Do you see that peaking? This is a big deal in the market these days.
So purely from a technical perspective, the 114 level that we recently had, that was a very good level of pivot from a trend channel, from a longer term point of view as to how far some of the mean reversion indicator had peaked. So it's reasonable to say that we are in an environment that US dollar is probably likely to begin to consolidate. I'm not sure if I want to suggest that it's over in terms of rising or strength of the US dollar, but it's very reasonable to say that the next bigger move or the next bigger environment for US dollar is probably about consolidation, more of a range bound, something similar to 2015 and 16 that we had. That probably will give the dollar some overbought relief, and then it will probably be able to resume its strength again. But as it stands, I would say the 110 is a technical pivot. Below that, we're looking to as low as 108 and 106 for DXY index, and that would be supportive for equities, in my opinion, or at least risk assets, if you will, just
Hmm.
given how its strength was, putting a lot of pressure on risk asset returns.
And where does that leave the Canadian dollar? I find it so interesting. And I don't know, I mean, certainly the weakness in the Canadian dollar has been a reflection of the strength of the US dollar, but it's also interesting in terms of having such a strong price of oil, and yet it wasn't really reflected in the Canadian dollar. And we are so often viewed as a commodity currency, but it didn't help. And sometimes that can be a reflection of what the global players think of the Canadian economy. But what are you seeing from a technical perspective on the Canadian dollar?
Precisely to your point, the fact that the commodities were not able to help the C dollar, and it's very reasonable to say that the strength of the commodities in general are becoming also questionable as we go forward with the strength of the US dollar or the slower global growth, perhaps. That's not going to help the C dollar either on that front, right? So we are viewing C dollar to be at best range bound with a persistent low or high pattern. So C dollar in our estimation is likely to stay on the weaker side. It will have bounces, but those bounces are technical mean reversions within a structural downtrend that is likely to keep pressure on the C dollar. I don't really see the cycle for the C dollar to be over yet either, right? So we do assume at best we will consolidate or bounce, but resume downtrend forces as we go forward.
Hmm. Yeah, it's amazing how much damage has been done to the Canadian dollar. But I want to pick it up on the other side of the break in terms of your outlook for 2023. A little bit more optimistic, and also, of course, get your take on some of the top stocks that perhaps have some opportunity right now, and also maybe some sectors as well. But we'll be right back. All right, so Sid, as we look forward, October tends to be a volatile month. What do you see for November and December, and importantly as well, your point about the third year of a president's term being more optimistic for the equity markets. What are we seeing right now going forward?
Sure. So by all historical measures, when we look at presidential cycles, by that I mean, where we are this year being a midterm election, year in the U.S. Presidential cycle, and typically it's a back end, and loaded type of a year. Best returns are historically seen between October through to December when we look at U.S. returns from an index perspective, right? So we are optimistic between now through to year end, but with limitations. Catherine, was like what I said, we're dealing with a market that has a downtrending backdrop. It has a falling 40-week or 200-day moving average. Many stocks are still decisively below that falling average. So any call it retracement back to those falling moving averages are likely to offer resistance, which will keep the market capped on the upside. So we do assume counter trends will come into play, but it's more about a mean reversion oversold condition, not necessarily in our estimation being the start of a new upcycle. We also wanted to suggest that this year is the biggest year in terms of tax loss selling or harvesting compared to 2008. So we do have some inhibitions for even a market that wants to rally. It does have natural selling from a tax loss perspective. As we
Because
go
there's been so
forward,
much
though,
damage that's been done. Because there's been so much damage that's been done, people are just going to do the tax loss harvesting.
yep. I mean, that's usually the case. In Canada, retail starts by mid-November through to mid-December. In the US, a lot of mutual funds begin that process in October. So US has already been in the progress. But next year is year three in presidential cycle. All our work suggests that year three is the strongest year in the cycle. It also makes sense to us. We have done a lot of damage. If there's a narrative about recession to come through next year, market will probably will have that priced in to some extent, and usually the strength of the cycle begins as we go into Q2, Q3, and Q4. So I think maybe Q1 would be a little bit of a challenge next year, but I think my assumptions, at least based on our work, suggest we're not only oversold, but also the cycle is in its length is very much being done 12 to call it 18 months, a typical age of a bear. And I think that will be able to help as we go forward in 2023.
I know it's almost as though we want to get to 20, from what you're saying, we want to get to 2023 right now. Let me ask you as well, before we get into some of the stock ideas, what's your view on the energy, or some are saying super cycle?
I think energy, from where it stands from our point of view, is a late cycle sector, right? Usually late cycle sectors are about energy, utilities, consumer staples. We've already seen the utilities responding and coming off lower. We've seen the staples having been very rich by measures of earnings, if you will, right? And they're starting to respond also accordingly on the downside or correcting. Energy is the last sector typically to respond. Breadth in the energy sector is still very strong. We can't really suggest for anyone to have a negative bias for the energy sector because it is very strong. Momentum is very strong. Relative factors are very strong. So it's a sector that is naturally going to come up for everyone who runs a quantitative model or a technical model, or even fundamental models, right? I mean, at these prices, the cash flows are amazing for a lot of these companies, right? But I still want to stay with my own discipline and suggest that breadth in the energy sector may have peaked already, and it's becoming more about pair trading within the sector or picking up laggards that may be able to still participate on the upside. But be mindful that we may have seen the strength of the sector internally. So in other words, we do need some consolidation for the complex.
Is there any other sector that is also showing some relative strength that you're suggesting? Because it seems though the only thing that's working is energy. I've only got about 10 seconds left in this segment, but any key other sector to
Yes,
watch to the upside?
yes. U.S. industrials are showing a strong relative performance, as well as the healthcare and biotech area is also a good area of focus for us. So I think it has become a market of stocks.
Sid, I just want to pick it up now in terms of stocks. You see, it's really a market of stocks, not necessarily sectors or the broader indices, correct?
That's correct. We do assume that investors should focus on pockets, focus on relative trades, and be a lot more active, not necessarily passive, be active in this current environment.
And so where does that leave you in terms of some of the stocks that right now look like buys? What names do you like here?
Yeah,
Let's go through them.
sure. I mean, let's focus on energy, as you alluded to earlier. We do assume if anybody wants to do a pair trade strategy, we have Cenovus to be one of our strongest ranking names in our models. We put Cenovus against Imperial Oil IMO, right? So that pair makes sense to us on many metrics that we use for gauging momentum as well as relative performance. We also have Intact as one of our strongest names within the complex of financial sector in Canada. So that's another name that we like and we favor. It shows well in most of our basket. The range bound stocks also show well in our work because if you're in a downtrending market but the stock is range bound, that tends to bring about alpha for us, right? And we're focusing on the likes of QSR, for instance. That's a range bound stock, and we know what those range boundaries are, and we do assume that there are more upside on that front. Dollarama is another good defensive name, and I think that may be attractive on every metric that we show out there. So I would say, to some extent, a defensive bias, but yet still maintain an element of momentum, i.e. energy is still a good area of focus. Range bound stocks like QSR would be good. Dollarama is another great stock that showed quite well for us. So I'm thinking as we go forward into earnings, by next week, we should have seen a lot of the numbers out there, and markets should have by then have digested and priced in a lot of what numbers may look like as we go forward. So by next week, we should have a better gauge and understanding what this market's going to do from an earnings point of view.
And there's been quite a bit of focus as well on Cameco, CCO, just in the broader news, business news. What's your view on that stock these days?
So we restricted Catherine on that. I don't have a lot of views, but
okay.
if somebody is running a model, it shows well on many technical metrics, right? We try not to talk about Cameco.
Okay, if you're restricted, we won't talk about it. And what about FNV or Nutrien, Franco-Nevada or Nutrien?
So Franco-Nevada is a good name for us. We put that name in our baskets as you know, we have a monthly basket that we publish for investors, and that's one name. Nutrien is also a good name from a seasonal perspective. Fundamentals are very good. Jacob Bout, who covers this name, is very positive on the name. It shows well in our work. It's in a consolidation format right now, and we do assume that uptrend forces are still very much intact. So setbacks are buy opportunity, right? So we're monitoring for this consolidation to be able to give us another uptrend resumption. But to your point, Franco is a good name. I think it has been slowly bottoming. Gold seasonality tends to improve as you go into December and January. So investors may also focus on that as well.
Okay. And just real brief here, and lastly, perhaps, what about the Canadian banks? I think so many of our viewers own the Canadian banks. They probably don't trade them, but probably want to get a bit of an update in terms of how they're looking technically.
I would say anything that pays over 6% yield historically in Canada has been a good place to be when you look at the bank sector, right? So that's one way of looking at it. But from our perspective, it's still very difficult for me to bring the complex into our models. They don't have a lot of relative strength yet. They don't have a lot of momentum yet. Banks tend to do well in a stronger rate of change of GDP. And as we go forward, we are assuming that rate of change probably going to be declining, right? So that's probably going to keep the complex still at bay for the time being. As you know, they all have a heavy downward trending backdrop, and they're, like I said, they're at best range bound, but they do pay a good dividend. To your point, investors do own them, and they don't let them go, and I think that's still the right attitude. But anything
Okay.
above 6% have historically been a good entry point for investors.
Okay, great. Sid, great to be with you. Thank you so much.
Thanks, Catherine. It was very good seeing you.
It was great to see you. And thanks everybody for watching.